Heartily welcome you all to the subject of Corporate Accounting 1, Module number 1, Issue of Shares and Debentures. This is session number 1. In this session, we are going to discuss with introduction to issue of shares and share capital, meaning of share, types of shares, meaning of share capital, and also types of share capital. To move to the next slide, this slide is going to show you the learning objectives of this session. This session objective is to make you all to understand the meaning and types of share capital and as well as shares. And the next objective is understanding the meaning and basic concept of shares and share and also types of shares. To move with the first important concept, that is introduction to share and share capital. Normally when joint stock companies need capital in order to run their business, we need total capital. The capital can be borrowed by the company by issue of shares. The entire capital will be divided into equal value units. Each unit in that particular total capital is known as a share. The second point is capital required for the business can be borrowed from shareholders. Shareholders are the public. Company borrows this capital from shareholders by issue of shares. The amount of capital so borrowed by the company from shareholders is known as share capital. Whatever amount of capital which company borrows by issue of shares to the public, the total amount is called as share capital. The fourth point is amount of share capital is divided into various units for convenience. As I told you, the entire amount of capital which company borrows from from shareholders is called total share capital. That total share capital is divided into various units for convenience, because an individual person can buy these shares in such a way that total capital is divided into many units. Each unit in that particular share capital is known as a share. Meaning of share is again the same. A unit in the total capital of share capital of a company is called as a share. The shares can be mainly classified into two categories. One is preference shares, another is equity shares. As the word itself indicates, preference shares are the shares which carry preferential right in the payment of dividend by the company, and also while returning capital by the company to the shareholders from whom the company borrows capital at the time of liquidation of the company or winding up of the company. And also one more thing is preference shares carry fixed rate of dividends normally. Equity shares are the shares which do not enjoy preferential right from the companies at the time of distribution of dividend and also at the time of returning capital to shareholders at the time of liquidation of company. So to elaborate the types of preference shares can be classified into 8 subcategories. The first category of preference share is cumulative preference shares. As we know that preference shares carry fixed rate of dividend. When the company earns a profit, company distributes profit to both equity shareholders as well as preference shareholders. But preference shareholders carry a preferential right in the at the time of distribution of dividend. But cumulative preference shares are the shares which receive profit, shares which earn profit, which receive profit for all the years irrespective of the loss or the profit made by the company. Say for example, this year if company has incurred a loss, this year's dividend will be paid in the coming years, in the future years when companies make profit. That is the type of preference share called cumulative. So, look at the meaning. Shares are entitled to recover the arrears of dividend belonging to the previous years. That means in previous years, if company goes under loss, such loss will be recovered by the shareholders in the future years when company makes profit. But non-cumulative preference shares, such opportunity will not be given to them. Only those years in which company makes profit, they receive dividend. Redeemable preference shares are the shares whose amount will be returned by the company after a certain number of years of time before liquidation of company. But irredeemable preference shares are those shares whose capital will be returned by the company to the shareholders only at the time of liquidation of the company. Participating preference shares are those preference shares which enjoy additional rate of dividend apart from the fixed rate of dividend in case of surplus profits. But whereas non-participating preference shares are those shares which do not get additional or surplus dividend apart from the fixed rate of dividend. Convertible preference shares are those which can be converted into equity shares after certain number of years, whereas non-convertible preference shares are those shares which cannot be converted into equity shares in the lifetime of the company. To move with the next concept, that is share capital. The share capital is an amount of capital raised by the company by the issue of shares to the public. This is total amount of money which company collects, raises from the public by issue of shares is called as share capital. Share capital can be classified into the following types. Number one is nominal or authorized capital. It is the total amount of capital which is authorized to the company in order to borrow from the public in the memorandum of association of the company. As we know, joint stock companies will have two important documents. One is memorandum of association, another is articles of association. In the memorandum of association, for any company, this amount will be mentioned, that to that extent company can borrow capital from the public maximum. That is called authorized amount of capital. This is the nominal or face value of the shares which the company is authorized. Company is authorized to borrow certain amount of capital from the public. A company cannot go beyond that capital. It can borrow only up to that limit. That is called nominal or authorized capital. Whereas issued capital is the part of the authorized capital which company can issue to the public for public subscription. Whereas subscribed capital is an amount of capital or amount of shares which public have purchased or subscribed from the company. Whereas called up capital is the part of subscribed capital which is called by the company to the shareholders to make payment. And the last one is paid up capital. This is the capital which is paid by the shareholders actually to the company out of called up capital. To give an example, I can mention this way. Say for example, maximum 1 crore rupees of capital which company is authorized to borrow from the public. That is called authorized capital. Say that is mentioned in the memorandum of association. But time being, company is going to issue 50 lakh rupees worth of shares to the public. Out of 50 lakhs, shareholders have purchased 30 lakh rupees worth of shares. Shareholders or public have subscribed 30 lakh rupees of shares in the company, and company has called time being 10 lakh rupees from the shareholders to make payment, out of which shareholders have paid 8 lakh rupees. That is called paid up capital. This is about the first session. Thank you very much for listening.